Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So in this video, we'll do a recap of some of the moves that are in the public portfolio. Then we'll do a recap of how the portfolio is doing overall. We'll do a recap on some of the events that affected the market this week. So with all that said, let's get right into it. But before we get into it, I just wanted to say that even though on this channel we talk a lot about stocks, real estate, and personal finance, the events that are going on in Ukraine right now are very tragic and they're very hard to hear and watch about. And that my heart goes out to all the people whose lives have been impacted by these events. So as usual, we'll deposit $10 into the portfolio. And in recent weeks, I haven't done any buying, but this week I did decide to buy it. On late Wednesday night here in California time, we got news about the worst case scenario happen with the tensions between Russia and Ukraine. And that night, Russia began its invasion into Ukraine. And news of this caused commodities like oil, wheat, and gold to skyrocket. But at the same time, it also caused stock futures to fall sharply, with the S&P 500 futures down over 2%. Anytime we hear any bad news about the Fed overnight, usually it may go down like maybe 0.5% or 1%. So for it to be down, I think it was somewhere around like 2.5%, is a really big move to the downside. So that following morning when the market did open, I did make a couple buy the dip purchases. We bought some Tesla. We bought $3 of Tesla at $749.97 a share. Then we bought some Enphase as well. We bought about $2 worth at $125.21 a share. We bought $3 worth in NVIDIA at $220.19 a share. We bought some Etsy as well. We bought about $1 worth of Etsy at $113.79 a share. Etsy did announce earnings later on Thursday after the bell, but we'll get into details about that later. One of the common things you notice about some of the stocks that I talked about, they're larger growth tech companies that are profitable. And the reason why I want to stick with profitability and growth is mostly because growth is really where I am when it comes to the stock market. And I also want the profitable route because, in my opinion, in a market where you're starting to see the cost of money go up, it's the profitable companies that tend to retain value a lot better than unprofitable companies. And for example, unprofitable tech company would be something like a Robinhood or a Matterport, something of that nature. And you could tell by the way their stock has moved recently what I'm talking about. So let's go into iPad and do a quick recap on how the portfolio did this week. So currently the portfolio sits at $200.71. And this past week, we're up about almost 0.5% or 85 cents. Overall for a portfolio, we're down almost 21% or about a little over $52. So even with the buys we made this week, we still currently have about $32 of cash to spend. That would be like 15% of the portfolio. So we still have some cash to buy more dips if we do see more dips in the future. So the first position we have here is Enphase. One of the things you guys probably didn't notice is that when we go through the portfolio, the higher weight stocks are at the top and the lower weight stocks in the portfolio are at the bottom. So this is the first time I've ever seen our Enphase position overtake our Tesla position. So it's pretty interesting. Currently, our Enphase position is down about 5% and makes up about 18% of the portfolio. During this week, Enphase did run mostly because of the skyrocketing in oil prices we saw, especially as soon as the invasion started. And our Tesla position is currently down about almost 7%. It makes up 16.7% of the portfolio. Tesla did fall pretty sharply off the news of the Russian invasion. It did somewhat recover throughout the latter half of the week. But overall for the week, it was still down. So the next position we have here is Etsy. Our Etsy position is currently down about 20%. And makes up about a little under 10% of the portfolio. Again, we'll talk about Etsy later on, but that's how it's doing the portfolio right now. Next position we have here is Alphabet. Our Alphabet position is down 6% and makes up about 9% of the portfolio. Google is one of those profitable tech companies that I did talk about that would be a really good company to have in your portfolio right now. This isn't financial advice. This is just my own opinion on it. I do like Google. They are obviously one of the biggest companies in the world. I don't think that they're going to suffer too much inside this kind of environment we have with so much economic uncertainty. So not a bad stock to have. Next stock we have here is Robinhood. So unlike Google, Robinhood is an unprofitable tech company. And for me at the moment, I'm not necessarily interested in buying the dip on these kind of companies. I think that there's still more room for them to fall. Also, I'd much rather use my money to buy stuff that's a little bit more safer right now. Currently, our position in Robinhood is down almost 57.5%. It makes up 8.5% of the portfolio. The next position we have here is NVIDIA. Our NVIDIA position is down a little over 5.5% and makes up about 8% of the portfolio. Again, NVIDIA is on that list of profitable tech companies. I do like holding NVIDIA during times like this, even if the valuation is a little iffy. Next position we have here is Amazon. Our Amazon position is currently down about 10%. It makes up about 3% of the portfolio. With Amazon, I don't think we're going to see any major moves to upside until we start to see supply chain and shipping constraints start to relieve themselves. So we will have to wait quite a while to see Amazon start to move to the upside. So the next position we have here is Cloudflare. Our Cloudflare position is currently down 11%. It makes up 3% of the portfolio. Not only is it an unprofitable tech company, but it also has a really high valuation. Really, in my experience, any company that's a software company that's more of it in its infancy, so something like a Cloudflare or a Palantir or a Snowflake, for example, they have really high future PEs. So this kind of market doesn't reward high future PE companies like this. Next position we have here is Trade Desk. Our Trade Desk position is currently down about 1/4%. And it makes up about 2.5% of the portfolio. Even with the bad news that we got from Facebook about advertisement going down, Trade Desk has held up pretty well throughout all that bad news. So next position we have here is Matterport. Like I said about Matterport, unprofitable tech. The market does not like unprofitable tech, so it rewards it by being down almost 56% in our portfolio. It currently makes up about 2% of the portfolio. So the next position we have here is SoFi. SoFi is stated to report, I believe, on March 1st. Which is this Tuesday. I'll most likely live stream it, so if you guys are interested, hit the subscribe and notification bell so you get notified when I post that video. But currently in our portfolio, SoFi is down 23% and makes up about 1.5% of the portfolio. Next position we have is Palantir. Like I said with Cloudflare, Palantir, unprofitable, high PE software company, so it's not faring very well. In our portfolio, it's down almost 50%. It makes up about 1.25% of the portfolio. The next position we have is Redfin. And our Redfin position is currently down almost 56% and makes up a little less than 1% of the portfolio. I think until we get more clarity of the future of the real estate market, which we'll probably won't see until the rate hike cycle that we're currently in starts to slow down. To do a quick recap on the earnings calls we got this week, Etsy did a report Thursday after the bell. And they raised the fee that they charge sellers on transactions from 5% to 6.5%. And to me, that shows that they're noticing increases in inflation and they're trying to get their cut of it as well. So I think that's the reason why we saw this bump up in the fee. When it comes to their earnings number, they beat on both EPS and on revenue, but their guidance missed by 10%. And even though their guidance did miss, the stock still ran on that news. And Etsy actually expects to bump up their margin from 22% this past quarter to an expected 26% the following quarter. On Wednesday night Pacific time, Russia invaded Ukraine, and initially their main target was to take out military assets. Things like surface-to-air defense, military depots where ammunition and military assets are stored, and things of that nature. And at the time of this recording, Russian forces are starting to make their way to the capital of Ukraine, Kyiv, with the possible ideal of trying to overthrow the Ukrainian government. But in terms of how this invasion is affecting markets, there's a multitude of different things that we need to discuss. The first thing is sanctions. Currently, the United States, the European Union, the United Kingdom, Japan, Canada, Taiwan, and New Zealand have all enacted various rounds of sanctions. And these sanctions aim to weaken the Russian economy and military by restricting trade to Russia of certain goods and seizing domestic assets from Russian elites. And Boris Johnson, the Prime Minister of the United Kingdom, went even as far as banning Russia's major airline, Aeroflot, from landing planes in the United Kingdom. These sanctions put a lot of downwards pressure on the Russian economy and its currency. And a couple hours after the invasion begun, the Russian stock market opened and was down about 30% within the first hour of trade-in. This is even after the Kremlin had disallowed short selling on their markets. Also, it caused the value of the Russian ruble to fall pretty substantially as well. The second thing we gotta discuss, how the invasion affects supply chains and inflation. At the onset of a geopolitical conflict, consumer demand starts to get pulled back due to fear of a conflict. And this helps reduce inflationary pressures. With the situation that we have globally, that's actually a good thing for markets, but it's only a good thing if the conflict is short-lived. If the conflict becomes more long-lasting, then it does have the ability to actually cause inflation to increase. And the reason why is because if you have any kind of war or invasion or violent conflict, that usually increases government spending. The increase in government spending is an inflationary force. And then one thing that's a little unique about this situation, that not all, but a good chunk of the inflation that we're seeing is in oil prices. Given that Russia supplies about 12% of the world's oil, we could think about it as, oh, it's only 12%, it doesn't matter that much. I know for me in my area, it's very hard for me to find gas that's under $5. If you go and take out 12% of the supply in the world, it's going to cause gas prices to move up even more, which only puts more pressure on inflation, especially given the fact that almost every part of our supply chain depends on inflation. If you buy pretty much any physical good, you have to use oil to move that physical good. So at the end of the day, it affects the prices of pretty much every physical good out there. Food, clothes, whatever you could think of that's physical. So it can be a major downside to inflation. And if we start to see Western countries start to ramp up their sanctions, especially if it starts to cross over into oil sanctions, we can see this inflationary problem becoming much worse. So it is something good to watch out for, is what's going on with these sanctions and kind of thinking, okay, if they introduce this sanction, how is it going to affect the market overall? Something really important to watch out for. So the third thing we got to think about is, how does this affect the Fed's rate hike? So ever since this invasion started, members of the Fed have started to become a little bit more dovish about their plans to raise rates. This conflict and ensuing invasion have definitely added quite a bit of cloudiness to the economic outlook, and this is causing the Fed to have to play rate hikes a little bit more on the safe side. But given that the Fed is so behind the inflationary curve, they have to still do some kind of rate hike in March. The Fed has acknowledged this as well. And even though we do have these new conditions on the market, FOMC members like James Bullard still states that he wants to see 100 basis point or 1% increase in the federal funds rate by July 1st. And currently the market is pricing in a 0.25% rate increase in the March FOMC meeting. We probably won't see the 0.5% that a lot of people were talking about before this conflict started. So that's basically all I got for you guys this week. Thank you so much for watching. If you enjoyed this video, you'll probably enjoy all the other videos I post on this channel. So consider hitting that subscribe button and notification bell so you get notified anytime I post a new video. Let me know what you guys think about the markets right now in the comment section down below. I'd love to hear from you guys. Also, check me out on all my social medias. I try to post there as often as possible. And thank you so much for watching. I'll see you in the next video.